I'll do tonight is try and explain what we do, so what EuroTrust is all about. I'll move on to talk about the history and how we've done historically, and also spend some time on the last 12 months, which has been a difficult period, and I'll explain why. Let's kick things off. Let's move straight in and talk about my approach. So what is EuroTrust? EuroTrust is an investment company that can invest in listed businesses throughout Europe, excluding the UK. And what we in particular focus on is trying to find one of two things. So one would be companies that we like to term the good businesses of today. And these, as you can see on this chart, are the compounders. These tend to be businesses where the return on invested capital of the company is high, and we believe it is sustainable. So higher than the market and more sustainable than the market assumes it to be. These are brilliant quality businesses, very difficult to find them, but we spend our time trying to do that. So those are the compounders, the good businesses of today. What we also do is try and identify companies that might actually not have a high return on invested capital when we look at them, might not have a high margin structure, might not even generate any money or any margin at all. But they're businesses that there's something about that company or something about that industry that suggests to us that return on invested capital is going to improve over time. And really importantly, we need to be assuming that returns are going to improve more than the market thinks. Because if the average investor already thinks this is going to become a fantastic company, then it's likely to be priced in. So those are the two things that we would invest in: compounders, the good businesses of today, and improvers, the good businesses of tomorrow. Just to flick on to the next slide. Lots of numbers on this slide, so ignore most of them. I'll just refer to a few of them. So what I've shown here is the breakdown of the portfolio at the moment by compounders, improvers, and then the trust as a whole. And if you look at right at the bottom, you can see that we've got about 65, so about 2/3 of the fund invested in the compounders at the moment, and that's quite typical for us. And we've got about 1/3 roughly in round numbers invested in the improvers. And then if you just kind of drag your eyes down those two columns, you can see the characteristics of the type of company are hopefully as I just described to you. So the key thing to look at would be roughly in the middle of the rows, return on equity. I talked about return on invested capital. Return on equity is another measure of returns. And if you look along that row, you can see the compounders on average have a 29% return on equity, so very, very high. You know, if you invest £1 of equity in that business, you know, you're getting 28-29 pence back per year. You know, a very attractive return. If you look at the improvers, 15.9% return on equity, so much lower. And that is exactly for the reasons that I said. You know, those improvers are hopefully the good businesses of tomorrow. These are companies that don't generate attractive returns today, but we believe will generate attractive returns in the future. And then if you blend those two categories together, so the 2/3 of the portfolio that are in those super high quality compounders and the 1/3 of the portfolio that's in those improving businesses of tomorrow, if you blend them together, you get to an average for EuroTrust as a whole. And you can see that in the fourth column, the third column of numbers. And the blended metrics, again, let's focus on return on equity. I think that's an important thing to focus on. You can see that we've got an overall 24% return on equity for the companies that we invest in on average, and the index would be 21. So our approach, by investing mostly in high quality companies today, and then also partially in businesses that we think are becoming high quality, the approach lends itself overall to being a higher quality exposure to companies throughout Europe than you would get by investing in the index as a whole. And needless to say, we believe in quality. We believe in owning high return on equity businesses. We believe that that is the way that over time we're going to make money for our investors, make money for our shareholders. That's a key part of what we do. So how have we done? This chart here shows performance And it shows performance over quite a long period, over 10 years. And in fact, EuroTrust has been around for 25 years, over 25 years. And we haven't stripped out the first 15 years because performance was poor. Performance was very strong. But you can see a clear pattern here, which is that over the long term, performance has been really good. But actually, over the short term, it's been a bit more challenged. Performance has been a bit trickier. And I'm going to go into a few slides actually to explain why the environment over the last 12 months or so has actually been, pretty difficult for the type of investor that we are, looking to buy high quality, high return on invested capital businesses. If I flick onto a slide showing our stock level attribution, as we would call it. So this is the contribution to performance over the last 12 months, well, roughly over the last 12 months to the end of September, of the individual companies that we own. There's some clear patterns here that will lead us nicely on to talking about the environment that we've been in. If you look at our strong performers, so those are the top 10 names on the left-hand side that produce those orange bars. So that is positive relative performance. So these companies have outperformed the market over the last 12 months. The pattern I would point out is that there's a lot of defensive businesses there. So without going into too much detail, we can pick this up in Q&A. Businesses like Novo Nordisk, that is a very defensive, it's a pharmaceutical company, so very uneconomically sensitive. So defensive companies, we've got Roche in there as well, Beiersdorf, that owns the Nivea brand, so a consumer skincare brand largely. And then there's also a lot of financials in there, and that's a very interesting aspect of the last 12 months, and an area that usually we don't have huge exposure to. But businesses like UniCredit have done very well, Munich Re, a reinsurance business, our second biggest contributor, and Deutsche Börse. And the presence of those financial businesses in the top 10 performers is really highlighting the environment we've been in, which, again, to ruin the punchline, is an environment of rising rates, an environment of rising interest rates and rising inflation. And I'll come on to describe how that hurts growth and quality investing in a bit. And then if you look at our negative contributors, these are largely really growthy companies. Grifols, a blood plasma company, Delivery Hero, a takeaway platform business, Worldline, a payments business, Euros, an online and e-pharmacy business. So generally, our growthier companies have done pretty poorly, have done badly over the last 12 months, and our more defensive companies or our financials have done pretty well. And that speaks to the environment that we've operated over the last 12 months. Moving on to sector allocation. Again, I'm flooding this slide with numbers, so let's not dwell too long. But if we go right to the bottom row, what you can see here, and if you kind of cast your eyes to the three columns on your right-hand side, the first of those three columns shows sector allocation effect, the second shows stock selection effect, and the third is a combination of them both. And to be really simplistic about this, sector allocation shows, have you made your performance or underperformance via your sector selection, so your choosing of sectors, or have you done it through your choosing of stocks? And in a good year as well as in a bad year, which the last 12 months has been, my attribution is all driven by stocks, and always tends to be. So a very small contribution from sector allocation, a very big contribution from stock selection. That will always be the same. And the reason is that I target my stock weightings in the fund. I don't think too much about sector weightings. I'm a stock picker. I'm not a sector picker. So let's move on to this environment that I've been kind of hinting at. This slide just shows some really simple things. I think most of it we're very aware of, but I just kind of wanted to work through the argument of why inflation is bad for the type of company I invest in. So what have we got here? In the top left chart, we've got just very simply US and Eurozone core inflation, which we can see running at pretty high levels and a dramatic acceleration really since kind of start of 2021. Oil, really interesting. We've seen a big pickup in the oil price and then just starting to come off in the last few months. This chart, bottom left, shows the freight prices, which, having done nothing at all for years, suddenly COVID hit. We had supply chain inefficiencies and freight prices went through the roof, and they've come off very sharply. And the US base rate, so the US interest rates, have increased over that time. So we've been in an inflationary environment, and what that has meant is that simplistically, growth equities have underperformed value equities. And a growth equity is a company that people buy because they're excited by the growth prospects of that business, whereas a value company would be a company that people buy because they're excited by a cheap valuation, not necessarily by any growth. And value has been the place to be rather than growth over the last 12 months, and it's because of that inflationary environment. So let's work through the logic on what's happening here. So this is quite a complex, quite an academic slide, so I won't spend particularly long on it. But what I've done is on the left-hand side, I've shown 3 types of company, and I'm being really broad about this. The top company would be a kind of super growthy company where people are really excited about the earnings of the business that might be there in 10 years' time. And actually, the business today is generating very little revenue. So it's a company that's growing very quickly from a very small base. So effectively, if this has got a £100 share price, all of that £100 of value relates to earnings well into the future. Company B sits obviously somewhere in between the 2 extremes. So company B has got a portion of the share price, let's say half of it, that is related to the future prospects of that business, the growth, the earnings that might be in 10 years' time. But half of the value in the share price relates to the current business today. So the assets the company has and the growth that and the earnings that it generates today. Company C, again, to be simplistic, is your value company. You know, all of the share price is to do with the business today. Nothing to do with growth, nothing to do with the future, all to do with the assets and the earnings power of the business today. Now, what happens if US interest rates, for argument's sake, move from 0.5 to 4, which incidentally is exactly what's happened, you know, over the last 12 months. US rates have moved from nothing to 4%. The discount rate, the rate at which you discount the future back to today, increases. Company A, that really growthy company that's very exciting in 10 years' time, all things being equal, the share price should go down by 30% to reflect the higher discount rate attached to those earnings well into the future. Company B, that kind of company in between the growth and the value company, should lose almost 15% of its value, the share price value, because of the higher discount rate. Whereas company C, where people aren't excited about the future at all and just see the present business as the attraction of the value in the company, the value doesn't move by anything. So this is exactly why when interest rates go up and when inflation goes up, growthier companies underperform, as shown by this slide here. In an inflationary environment, there is a bit of a headwind to the type of investing that we do. Goes without saying, it doesn't stop me doing what I do. I'm a firm believer that over time, discount rates may go up and down, but over time, owning quality companies is the way to make money for your shareholders. And that is what I will continue to focus on. So what have we done? You know, what have we done over the last 12 months, apart from, you know, lose the odd night of sleep here and there when, you know, when performance has been difficult? Well, this chart here shows the balance between compounders and improvers. And in Q1, which was the most acute period in which the growth companies underperformed value companies, you can see we increased our exposure to compounders. So we made moves to buy higher quality businesses in that tough environment. And you can look at this another way as well. These are portfolio level characteristics. So look at the whole trust compared to the index. And on this one, similar to the chart I showed you earlier on, the table I showed you earlier on, we've got return on invested capital showing us higher than the market, gross margins higher than the market, operating profit margins higher than the market. But what this chart, the next slide, shows is that these characteristics have increased so far this year. And that is even with those high quality businesses underperforming and so becoming a smaller portion of the fund naturally by the fact that they're underperforming. Our returns have improved, our gross margins have improved, our operating profit margin has improved. And the reason is that in this tough environment, and this really is the key message, in this tough environment, we don't put our head in the sand and start worrying about performance. We use it as an opportunity to increase our exposure to high quality businesses. We buy more of the type of companies that we firmly believe in long term, and we do it at a time when they're out of favor. I'll finish just by talking about a few of the companies that we've initiated new positions in so far this year, and then I'll try and leave a few minutes for questions and try not to overrun. Sartorius is a really good starting point for this part of the discussion. Sartorius is a German business. It's a biopharma equipment company. So it sounds pretty complex, but what they do is they produce the kind of tools and equipment that a big pharmaceutical company like AstraZeneca in the UK or like Roche in Switzerland would need to produce a biologic or a biosimilar drug. Biosimilars, biologics as well, are gaining huge share within the pharmaceutical industry. There is only 3 or 4 players that can produce the equipment that Sartorius produce, so that it's almost an oligopoly structure. It's a high-tech industry. It's one with substantial barriers to entry. And one of the beauties about this business model is that the equipment with which Roche or AstraZeneca will use to produce a biopharma product is decided well in advance of that product ever being produced. It's decided at the trial stage, and it's baked into the regulatory approval for that product. And that makes your customers, if you're Sartorius, very, very sticky, because AstraZeneca or Roche don't want to have to, speak to the agencies again to get permission to produce something. So it's a very powerful business model. And we've wanted to own it for years. I've looked at this business, I've known it well for years. But as recently as November last year, this business was trading on 70 times PE. So a price to earnings multiple of 70 times, which, with the market today on somewhere between 10 and 15 times is extremely expensive. So we really wanted to own it, desperate to own this beautiful business, this lovely high return on capital business, but we couldn't. It's too expensive. And if you go from November last year to March this year, because interest rates had gone up and because inflation expectations had gone up, this business had derated from a price to earnings multiple of 70 to a price to earnings multiple of 30. Still expensive, still double the market multiple, but a far more palatable investment case for us, where the valuation is more reasonable and the quality remained extremely high. So that is what we've been doing so far this year. We've been looking for opportunities in high quality, high growth businesses that the market just doesn't want to know about. And the market is selling, we'll be there buying. And we haven't been doing this aggressively, we've been doing this in a slow and steady way. Universal Music Group, UMG, is another example. Very high quality business, owns music catalogs. I could go on for far longer than this presentation would allow about the quality of that music content ownership. Airbus, I think we all know what Airbus do. Global duopoly. Besi is a semiconductor company, and Deutsche Börse, the German exchange. So those are the types of examples of the types of company that we've been buying.
Start off with, you described compounders and improvers at the start of the presentation. How early stage do you get with a company when you make that first investment with an improver?
Yeah, it's a very good question. So one of the things to bear in mind when you think about EuroTrust is we are not a venture capital trust. We're not a private equity trust. And also we're not a small cap public equity trust. So we invest in medium-sized listed companies or large cap listed companies. So if any of you guys are, more venture capitalists, my idea of an improver, a business that is in its early stages, will be very different to yours. So these are already established listed businesses, but that is not to say that they will be generating substantial profit at the stage at which I invest. And there are a couple of examples in the portfolio at the moment of businesses that earn no money at all. Delivery Hero is actually the best example. So early stage, but not companies that would be any smaller than around about $1 billion in value. So we're not delving in the small cap area, and we're not delving in the unlisted areas. It's all listed businesses above roughly $1 billion market cap.
That leads nicely to the next question, was how large is your investable universe? And you showed some new, the newer investments. What's the typical portfolio turnover?
Two good questions. So on the investable universe, within Europe ex-UK, I see about 800 companies that I could invest in, to give you some idea. And at any one time, we might invest in about 40 to 45 of those companies. So about 5% of the investable universe we've got a position in. That gives you an idea. What I would say is that well over half of that notional 800 companies that I could invest in, I have no interest in investing in. You know, these are not good companies. So, you know, I narrow that universe down voluntarily. So that's the answer to the first question. And the second one was on turnover. Very good question, and actually differs between the compounders and the improvers, as this chart is supposed to hint to by the length of the lines. With the compounders, with good businesses, ideally we want to own them forever. That's a very glib expression, but I think it really is true. If a business earns a high return on invested capital we think is sustainable, and that the business keeps proving that over time, we want to keep owning it. And we're far less sensitive to the valuation of those businesses over time. And there are several companies in the portfolio or compounders that have been in the portfolio for well over 5 years, some well over 10. So, you know, that is the compounders. Improvers tends to be a lower holding period. When you blend those two together, you get to an average holding period of somewhere between 2 and 3 years. So we're not ultra long term and we're not ultra short term. We're somewhere in the middle, with the compounders being longer ownership periods.
And we had a question about UK. I think we had another Henderson trust that had a little bit of a European focused trust that had a bit of a UK ownership. Are you completely ex-UK?
Yeah, we're completely ex-UK. It goes back to the history of EuroTrust when it was first founded and decisions that were made well before my time. But the intention was to offer UK-based investors a way to access Europe alongside some of the UK funds that they would already own, so that we kind of feel that, you know, a lot of those UK investors, you've got the UK covered, so we'll do the rest. You know, we'll do ex-UK, and that remains the case today.
Okay, next one. Does the trust pay a dividend, and if so, what? And then what is the dividend policy?
Yes, we do pay a dividend, and a very relevant question, because over the last couple of years the dividend policy has changed. So historically we had something that a lot of you would be very well accustomed to, which is a progressive dividend policy, where essentially we commit to the intention to pay out a higher dividend every year. The problem with that is that it can sometimes constrain your ability to invest in the kind of companies you wanted to invest in. And the board were very firm in their belief that they wanted me to be able to invest behind the best quality, the best growth businesses and the best quality growth businesses in Europe that I could find, irrespective of whether they paid a high dividend or a low dividend. And often, if you are, to keep this kind of compounders discussion going, if you are a compounder generating a 20% return on equity, I don't want any money back from you. I want you to invest every pound that you have, every euro that you have in your own business. So conversely, I want them to be a low dividend paying company. So what did we move to? Over time, we decided to move to a policy where we no longer commit to a progressive dividend over time, but the commitment we do make is that every bit of income that our portfolio companies generate, we will return to the shareholders. So we are slowly working down our revenue reserve, and that will be complete over the next couple of years, because if you don't have a progressive dividend policy, you don't need a revenue reserve, and we will pay out the income that our companies generate.
And can you say what the current yield is, or what the trust has paid in the last year?
Yeah, so the yield, I mean, you know, has obviously varied with market levels, but you know, somewhere in the 3 to 4% range would be reasonably usual. And in times when growth equities are a little bit more expensive and the valuations of the companies are a little bit more expensive, it'll be less than that. But that gives you a good idea.
Okay, final question. Do you have a performance fee on the trust?
No, we don't. That is something that we had historically, and something a number of years ago was decided was not in the best interest of everyone. And the board, obviously, you know, the singular interest and focus of the board is to make sure that the shareholders are served best over the long term, and that was deemed to be not the right way to do it. So a management fee is the only fee that we earn.
Very good. Jamie, thank you very much indeed. Thank you for speaking with us this evening.
Thanks for your time, guys. Thank you. Bye-bye.